Hello everyone, this is Sebastian McMahon from IA Financial Group. I'm back with the weekly economic review for the first week of 2026, so the week ending January 9th, 2026. So first, Happy New Year everyone. Thank you for your continued trust. It's always a pleasure to serve you. We have a big week here to cover. 2026 is off to the races. We are seeing geopolitical tensions rise. We are seeing very important pieces of the puzzle getting put together as we look forward to 2026. So we are constructive for 2026. Our base case scenario is that the global economy will accelerate. That it's good to be overweight equities, global ex-US, so emerging markets, Canada, Europe. We still think gold has a role to play in portfolios. We still like commodities. This is the base case scenario, but we need to work in scenarios in 2026 or in the Trump era, and we'll cover those scenarios at the end. But before, we need to set the stage here. But before we get going, maybe just to promote the latest monthly, which we just published this week. So the link is at the bottom of your screen right now. When you click on that link, you can click on see the PDF, and then you will see the document as is presented here with the table summarizing our current positioning. So the title of the piece, and this is our outlook for 2026, so I strongly encourage that you give it a read to understand how we see the year unfolding. And you know how we love music, so we like to use a song title every month. This month, what came to mind was Fuel by Metallica. So give me fuel, give me fire, give me that which I desire. I think it summarizes well how markets are viewing the Fed's role in 2026. So there's many things going on, but markets, especially US markets, are focusing on the Fed, saying, all right, so give us some more fuel, cut rates some more, because the labor market is weak, even though we don't think it makes sense economically to do that. There's political pressures, and the Fed is likely to deliver a few of those rate cuts this year. So our views are summarized there, but the conclusion is that 2026 is not a year to be defensive, it's a year to be flexible. So rotating the money around in asset classes, being active management will play a very key role here. So this is our piece. We recommend that you give it a read. Now, looking at this week's markets at the close on Thursday, so the year is starting pretty much as the last one ended. So the key word in 2025 was resilience. 2026, the key word should be continuity. Continuity in the themes that are generating the returns, but also continuity in the fact that the Trump administration will continue to bring unexpected risks and severe risks potentially also to the economy. But so far so good. Positive return for bonds, positive returns for stocks, 2% in Canada, the US, Europe. 4.5% for emerging markets. Let's see in a few months if the leadership still holds in emerging markets. But global ex-US is still doing fine as we start the year. Canadian dollar has pulled back versus the USD. USD has been strong, mostly doing its safe haven job as at the turn of the year. Interestingly, the USD is up and gold prices are up at the same time. So already the safe haven movement here is continuing. We do still expect the USD to be weaker than it is now by the end of the year, but we'll see. So far, the USD has started off strongly. So looking at the recent headlines here, 2026 started off with a bang. Of course, the U.S. captured Nicolas Maduro, the president of Venezuela, and is being on trial in New York. It's the first for a country like the U.S. to go capture a president elsewhere and to bring him to law, but before U.S. judges, so U.S. law, not on the case of international law. So usually when there's an operation from one country to another, there's three reasons based on international law. Either it's self-defense, it was not the case here. Humanitarian reasons, it wasn't obviously the case here, or because there's a mandate by the UN. And in this case here, none of those conditions hold. Now, the US could run Venezuela for years, Trump says, so expect that to hold. Likely they will be running it for years. And control oil sales indefinitely, so that means for quite a long time, likely. Russia also a warning of spike in tension after the U.S. seized an oil tanker, and the oil tanker in question was, is reported to have been carrying embargoed oil from Venezuela, likely to Russia, to other countries. It's not clear if it was a Russian ship or not, but you get the picture here that Russia is getting into this thing here, and also what is going on here. Very strong implications with China as well, which I'll discuss in a few minutes. But before I go there, it's very important because oil is very important to Canada. It's important to understand what this means for Canada here and what it doesn't mean, because there's some disinformation floating around. So trying to set the record straight here. So here, Venezuela holds the largest oil reserves in the world. So it's over 300 billion barrels of oil. So Venezuela would be number one. Saudi Arabia number two, Iran number three, and depending on the source here, I use visual capitalism, but I've seen from other sources, Canada is either number four, number five. With Iraq, they can trade that place, but Venezuela holds about 17% of global oil reserves, but they are responsible for at most 1% of global oil production because their supply chain has been broken, underinvested, for political reasons. There's been some terrorism acts over there. So their capacity to extract that oil, it has dwindled to, a shadow of what it used to be. And now the US wants to bring this capacity back. And the official reports are that it would take at least a decade, at least $100 billion US, or about $10 billion per year, to bring it back to its, let's say, full capacity. That means that the oil that is produced now in Venezuela is economically interesting, but the oil that could be added to the production, that one, the average price would be hefty, and reading reports that it could be a break-even cost of over $80 a barrel, and now we're seeing the price of oil at about $56, and Trump has been very, very vocal, saying that he would love to see the price of oil at $50 because he's a populist president. And if you want to bring prices down, you need to raise production, mostly. So companies would be extracting oil at cost 80, selling that at 50. So it's a hard sell for any business to want to go into Venezuela to invest to raise that production. So let's see if it happens. But for now, Trump is pushing very hard. Let's say that it happens. Now you move on the right. All right, so Canada's oil exports to the US. So most of our production in Canada is exported to the US. About 4 million barrels a day goes there, and we produce about 5 million barrels a day. So there's a few regions in the US, they're named PAD. So most of our market is PAD 2, to the Midwest. So most of our main pipelines go from Alberta to the Midwest. And Venezuela produces heavy oil, and we produce heavy oil. So it's easy to say, well, they're just going to be replacing Canadian oil with Venezuelan oil, and we'll be left on the wayside. In the long term, the US can do whatever it wants. So over the next 10, 15, 20 years, maybe things like that can happen. But in the immediate, we're sending oil to the Midwest, and there's no pipeline capacity for Venezuela to just ship oil to the US and then reverse those pipelines and replace our oil in the Midwest. It's not economically viable, at least in the short run for the next few years. So we seem to be safe there. Where there's some risk is in the Gulf Coast region, where, of course, they can just bring oil through ships and just substitute. But at some point, they will have to retool some of their distribution and their supply chain. So it's not like it's going to be going on like that. but there's a risk there. So of course there's a few consequences here. First, it raises the importance of getting our act together as a country into exporting our oil. So provinces and federal government, shipping some of our oil to Asia to diversify our sources. I mean, the urgency is back, and Daniel Smith is very right talking about this. And let's hope that it gets things moving for sure. And also, for the U.S., it's not true that they can that it makes economic sense to just substitute everything away like that here. So it's going to take some time here. But this is the picture, so don't think that it's as easy as that. And of course, as I mentioned earlier, they will need to ramp up production, and they will need to invest massively. And does it make economic sense? We'll see. If maybe the federal government will want to pay for that in the U.S. and make the businesses will then jump into the project because it's not their cost, but it's going to be their profits. We'll see. For now, the prices are not moving that much because the oil is not coming in, but of course, valuations of those Canadian energy businesses could be impacted in the short run. So an important development, but maybe not as immediate as what we might think. Now for what's going on, what's the big picture behind all that? So let's talk about what they call the Monroe Doctrine. So first, a history lesson. James Monroe in 1823, he was the 5th president of the U.S. The U.S. was still in its infancy, about 40 years plus removed from independence. And so the president of that young country, let's say, published what he called the Monroe Doctrine, which was pretty much just summarizing very simply here, telling Europe that you're not colonizing anymore the Americas. So the Americas, North and South and Central Americas, are the U.S. backyard. Stay over there. It's our backyard now. And anything that you do in the Americas, any attack that you make or colonization efforts, we will view that as an aggression. And back then, the U.S. was weak economically and it was weak militarily. So it was more lip service and I think, but it was just like standing up to the big men in Europe. Now, Donald Trump, of course, he likes to put his name on everything. So when they published their national security strategy in November, he called that the Monroe Doctrine for Donald Trump and Monroe, you get it. And they went much farther than that. And it's pretty much that the Americas now, in the Americas rather, the American interests should predominate. The U.S. interest should predominate in everything. So pretty much like this is our land and this is, we get what we want in the Americas. And, when we read that, I mean, of course, it was typical Trump material, but now that they took on Venezuela, now that he's talking even more about Greenland, some of the sentences there, lines in the document make more sense. And one is that, pretty much I'm quoting here from memory, but it's that the U.S. should do everything in its power to push away any foreign companies that is investing in infrastructure in the Americas. So now we have a big problem because here this is a map from Eurasia Group. As the title said, now the world is too fragmented to hold spheres of influence. To say that this is my backyard, your backyard is over there. Economic interests now are spread around the globe. So chart on the left, security order, like based on primary military alliances, defense partnerships. As you can see in the Americas, it's mostly blue, so mostly US aligned, some non-aligned like Brazil, which is green. And you see some yellow, which is Russia aligned, but of course Venezuela was there, it's not that anymore. Cuba, but for how long? And Nicaragua, so we'll see about that. That was already likely mostly aligned, but if you shift to the chart on the right, economic order, well, South America now is pretty much aligned economically with China. China has invested in ports, in minerals, in energy, there's BYD plants being built in Brazil, for example. So now security bleeds into economic order, and you can have some issues in China. This week, they warned the U.S. They said, all right, if you take some of our companies as hostage, we will do the same with your companies. And they said that, remember that the US also has economic interests globally, and they have big economic interests in China. So the message that the world is too fragmented for you to say that this is your backyard. We've invested lots of money in South America. So the tensions could flare up between the US and China based on what's happening, even if we're not mentioning China in the Venezuela and Greenland thing. it could flare up. For Greenland now, is the U.S. going to clash with NATO countries? Are they going to really want to use military force to move against a NATO ally? So what kind of world would that be? So that leads us to the next slide here, thinking in scenarios in the Trump era. So again, just to repeat, our base case is that there's a constructive macro backdrop that will lead to pro-cyclical types of returns. That means bullish commodities, bullish stocks, just to summarize. But the main risks, U.S. strategy on security could lead to economic chaos. Increasingly likely, 20% odds that there's some chaos. I don't mean extreme chaos, but some chaos. U.S.-China tensions could be flaring up to a new level, as I said. Clash with Europe per dissolution of NATO. Is that what could happen? And remember that since World War II, let's say the Western world as we know it has pretty much been shaped by NATO, by the existence of NATO. So what does a world without NATO look like? It's very hard to fathom what that looks like, and I don't think that markets are pricing that at all. So there's those risks that are important. And of course, another risk that is important is maybe the labor market is keeping the Fed on the sidelines. We'll see. It means maybe the labor market is a bit too strong for the Fed to justify rate cuts. We'll see, but we think it's a low risk because most of the investments now are made in data centers, and data centers do not create a lot of jobs. We don't expect a booming labor market, but there's all of those considerations. And the last consideration is what you see in the bottom. The concentration of wealth in the U.S. makes the U.S. economy more vulnerable to a market downturn. In clear terms, the top 10% of earners explain 50% of consumption spending in the U.S. So if you have a downturn which is significant at some point, maybe not in 2026, but let's say, and we don't think that there's a bubble in AI, but let's say there's a bubble that forms in 2, 3, 4 years, and then that bubble bursts and we have like 10 years of consolidation like we've had in the 2000s in the US, well, that could have very important economic implications at some point. So those are the risks here that are resulting for everything that we're seeing in this era. So again, just set the table for the year here. Now go last slide on this week's data. Job market in the US, 50,000 jobs. That's a bit weaker than expected, but that's just good enough to say the economy is creating jobs, but not just weak enough for the markets to think that, well, the Fed will still be cutting. So we can see that as bullish. And on the right, we've had 3 very solid employment reports in Canada over the last months. Now, what was expected was a negative print. We got a small positive print. So, market is seeing that also as a positive signal. For 2025, in both countries, job creation was relatively weak overall. 2026, we'll see if it accelerates. It's possible that we see an acceleration in Canada. In the US, let's see with how the parts fit in the US. But just remember also that in February, Statistics Canada tends to revise and smooth out the data numbers, the job numbers in Canada. So maybe you'll see less volatility in a few months when these data are revised. So that was a big week to start the year. Should be an interesting year. So it's always a pleasure to serve you. If you appreciate the content, of course, please share. And of course, come back next week.